Hey everyone, welcome to another video on my YouTube channel, and today in this video we are going to look at a mistake which most of the investors do, and they are going to pay a huge price for the same. This mistake comes down to the fact that investors often tend to wait for the crash before they invest. Not just this, if the market starts to crash, so their idea would be once the market starts to come down, I am going to invest. But when the market actually comes down, they would wait for further crash before they actually end up investing. So today I am going to take the data, crunch the data, and also show you how people have lost more money waiting for the crash than actually in the crash itself. If a person had done continuous SIP versus a person who had invested post the crash, so how much would each of the investors would have made and what would be the difference? And towards the end, we will also discuss way to optimize our overall returns and improve our overall returns with respect to the risk. So in case if you are an option trader who generally invests pledge and trade, or a full-time investor, I am pretty sure this video is going to bring a lot of insight. Before we move on, make sure that you hit the like button, share this video and subscribe to my channel. And now let's move on to the screen recording. Hey guys, welcome to another screen recording, and today's video is going to be completely data driven. So I'm going to present you a lot of data and few stories. So I have done a lot of data crunching over the past few days to make this video. So close to around 3.5-4 hours to analyze the entire thing. So you hitting the like button and the subscribe button would really mean a lot. So make sure that you hit it right away. And now let's continue with the video. So now you can simply go and ask one of your friends who is yet to invest, so why don't you start investing? So he would tell you currently the market is at all-time high. So this is the Nifty chart right over here. So he will tell you currently Nifty is trading at all-time high and he is not comfortable investing. The moment Nifty comes down by 10%, so he will definitely end up investing. So he will tell, let Nifty crash by 500 or 1000 points, I will for sure invest. Right? So this is a very common thing which we get to hear. But in reality, all of us know for a fact that when Nifty is coming down by 10%, hardly few of us would really have the discipline to invest, right? So it is not just one occasion where we have seen Nifty fall 5 or 10%. Many times Nifty has fallen over 1000 points, but very few of us have actually have the discipline to go and invest at that point. So today what I'm going to do is I'm going to see if we have done a simple SIP for the last 10 years versus if I had invested a lump sum every time Nifty crashed by 10% or more, assuming that Nifty fell by 10% and I invest a lump sum at that point. So what would have happened? So which do you think would have given us more returns? One is when you invest a lump sum whenever Nifty crashes by 10%, or if you simply do an SIP, right? So let me know in the comment section what you think of it. And now let's get to the data. So right over here, you can see I have 10 years of Nifty daily data. So this is open, high, low, close of Nifty for previous 10 years from 2014 till 2024, right? So using this data, I have already done the data crunching. So I will just present you the summary, right? So first let's discuss about our initial strategy. So the first strategy, I will simply name it as a downturn strategy, right? So the strategy is pretty simple. Every time Nifty is crashing by 10% from its peak, so whatever is the peak, the moment Nifty comes down by 10%, I am going to invest 5 lakh rupees as a lump sum amount. So you can see in the previous 10 years, you have only got 6 instances where Nifty has actually come down by 10% or higher. So this means on an average, every 2 years once you get a chance to invest this lump sum amount, right? So you can see the previous one, what you got was in 2021. Right? So almost towards the end of 2021, you can also call it 2022 because this is in the month of December. So previous to that, it was during COVID, and earlier to that, you have got once in 2019, once in 18, and once in 15. With this, you would have totally invested 30 lakh rupees. That is basically 5 lakh into 6 different times. The second strategy is a simple SIP. So you're simply going to do an SIP of 25,000 irrespective of where the market is. Let the market be at the highest position or the lowest level. You're simply going to do an SIP of 25,000 into Nifty every single month. So when I sum all of this, so you can just look at the bottom. So you would have made a total investment of around 30 lakh 50,000. So almost you would have made an investment of 30 lakh itself. So which do you think would have given us a better return? So is it the lump sum strategy or the SIP? So if we actually come to the summary tab, so you can look at this. So in the downturn strategy, or that is whenever you put the lump sum, so you would have got an overall return of 108% compared to our monthly SIP, which would have given us a total of 101% return. So you can see we would have invested 30 lakh and our final value would be 62 lakh compared to our SIP, where we would have invested 30 lakh 50,000 and our final value would be 61 lakh. So just a difference of 1 lakh rupees, right? So now usually you don't see in terms of absolute returns, rather you see in terms of XIRR or extended internal rate of return. And when you go by that, so you see that the IRR is 13.98 or 14% for the lump sum one and 13.4% for the monthly SIP strategy. So looking at this, you see that there is no much difference at all, right? So there is a slight difference, but in my opinion, over a period of 10 years, this slight difference is not so significant. But I believe that a simple SIP strategy is way superior compared to the lump sum one. The reason is pretty simple. So here we have made an assumption. We are going to invest rupees 5 lakh every time the market comes down by 10%. But end of the day, we should know that our human behavior is going to come into picture. So the market is simply not going to crash 10%. So let us try to understand the instances where the market has actually crashed 10%. So you can see during COVID, so market fell almost around 20 to 30%. So assuming that when the market fell by 10%, you would have put the lump sum amount. So here during COVID, hardly few would even dare to put their money. So that to lump sum, we are talking about something, a real huge amount. So hardly anybody would really dare to put their money during such an adverse situation. If the market has to fall 10%, the situation has to be serious, right? So it is not easy for us to actually put that lump sum if the market crashes. Assuming that in this 6 different instances, even if you had missed out on one of the instance, your returns would be totally different. So in COVID, even though the market fell 30%, hardly anyone would have really put money. Now let's go back to another instance, that is during 2021 end or during 2022. So this was the time when Russia-Ukraine war was also beginning. Not just this, it was also the time when US Fed started to raise the interest rate. So the inflation in US was at its peak, so it was really high, and also the growth rate of the economy was really sluggish, right? So even in India, situation was not really favorable. It was much better than everywhere around the globe, but not the best, right? So there were a lot of uncertainties around. So at this point, if the market comes down by 10%, so there is a war going on, international war. So the world's largest economy is actually undergoing stagflation, but that fear is always going to be there. It is not easy for us to put out this lump sum amount as easily as we think when the crash really happens. So for example, so you might have heard of people telling that let the market come down by 1000 points, I will invest. So yesterday market was actually down by 1000 points. So if you take a look at this, so even this 1000-point fall came on back of some uncertainty. So one was the Iran-Israel conflict. The second one being Fed, which said that it might slightly delay the rate cuts. A lot of things happen. So this is how our human psychology works. So because of this, it is important for us to know it is much superior to simply do a regular SIP without having to break our head. You can also tell your friend to start investing right from today. Why? Because even though we are at the peak, eventually you are going to get the average prices only, right? So SIP is going to make sure that you are going to go back to the average. Even when the market is coming down, you are going to continue investing. So the second important thing what you have to note is you can also further optimize the returns by simply doubling your SIP amount every time we come down by 10%. So this is a small optimization to your SIP strategy. So every time we are coming down by 10%. So for the next 6 months or for the next say 6 to 8 months, you can simply double your SIP amount. So on an average, you will always be getting cheaper rate. So you will be investing 2 times the amount whenever the market is falling 10% from the peak. So this way you can tend to increase your overall returns by simply continuing to do your SIP. So do your SIP as it is. Whenever the market is coming down by more than 10%, simply double your SIP amount for the next few months. So this way you are going to get more units at a much lower price and it is going to boost your returns. So this was a short video on why there is no point in waiting for a crash and do your SIPs regularly irrespective of where the market is. So I hope this data driven video was insightful. So if so, make sure you hit the like button, share this video and also subscribe to my channel. Let me know in the comment section what are the other kinds of video that you are looking for so that I can make them and present it to you soon. Thank you guys and see you soon in the next video.